Hey guys, welcome back. In today's video, we are talking about the AMC leverage, the next short seller to go down, the 109 billion short position, and many more in this video. First, we're taking a look at this, the operational leverage, keep up the great work. So we're taking a look at this post from Retail Stock. I highly recommend people to take a look. But essentially what you're seeing is what we have been talking about for AMC, and it's why I've always highlighted the importance of how AMC is operating, because you can see here, visually obvious to see, CEO Adam and the team has made the company more profitable now than pre-COVID. Compare three similarly sized box office quarters from 18 to 19 to the one we just finished and see for yourself. Blue bars equals domestic box office, orange line equals AMC net income. Notice how we are at a higher earnings on a lower box office. So what happens as the box office keep winning? And you can see this. And so what we're looking at is obviously looking at the box office and then looking at the income that AMC is receiving. And what you'll see is how we are at a new height despite the fact we are seeing a lower box office. And so this is what we were saying with how AMC has optimized their business structures and made it extremely efficient. We are able to make more money with the same box office, and we are able to even make more money with a lower box office. However, what we have to realize is that the box office is only going to get bigger. We've seen how it's been improving. We're seeing how it's been increasing. And so you can understand that right now, when we see the box office going back to what it previous was, which I 100% believe that it will, you will see how AMC will do a lot better now than it did back then. And so this is why we've said, if AMC were to able to go up to the $720 with all the debt, with a lower box office, with a less optimal business structure, you can only imagine where AMC is going to go now. And I think a lot of people are, of course, just ignoring this and sleeping on this without understanding that when AMC gets to that stage, when we see the box office reaches a new all-time high and AMC is able to be so optimal and efficient and make the money that it needs to, do everything that we've mentioned in the past, that's when it's going to attract so many more new investors. Mainly, of course, the institutions, because the apes have already understood what's going on with AMC. We have obviously paid attention to this. But for the ones who are on the sidelines, wherever it's the retail investors who don't actually know how AMC is operating and are solely feeding off the news articles that are always talking about AMC without the correct information, or whether it's the fact it's the institutions who don't want to buy a stock until they've realized just how good of opportunity it is. But when that time comes, you'll know that it's too late for AMC. And it's why the apes have always said, and why we have always said, that this is obviously the biggest discount. Not just because of the fact that when it squeezes, we are able to make, hundreds of thousands of dollars, but the fact that even right now, and you compare it with where it will be in the future with its projections, in the future with real price discovery, it's still extremely undervalued. And so that's why we have to understand the importance of the fundamentals, but it's also about understanding how well AMC is operating. And then you can see that this is already having an effect on the short sellers. We're seeing them panicking now more than ever. You can realize this. Almost all of the orders going to dark pool, even publicly reported dark pool data is false. You can see the activity on the level 2 streams. What you're looking at for AMC, and you're seeing essentially all of these going through OTC, the dark pools. We've talked about this, and essentially what we're not seeing is that not an ounce of the trades that is hitting AMC that should be affecting AMC is actually having an effect on AMC. And the reason why we said this is because of what we've just talked about. When you see that a company is improving so drastically and it has shown how bullish it can be, how the projections, how much potential there is, the one thing you don't want it to do is having the investors come in and then pushing the price up, because that obviously hurts these short sellers. And they realize that. They realize already how it's attracting investors. And so they're trying to take away any cent of bullish movement they can from AMC. And so that's why we're seeing the dark pool usage go higher and higher. You can even see this, the dark pool alert. We're looking at 60% of over 7 million volume in terms of AMC shares. And remember, this is not a weekly volume basis. This is on a daily. This is how much we see every single day. In comparison, you can see here the off exchange in comparison to the NYSE is 7 million in comparison to 1.4 million. And what we have to realize, and it's something we've shown in the past before, is actually the orders that are all going, or rather mostly going into the dark pools, are all buy orders. Whereas a lot of orders that are hitting NYSE, the lit exchange, so the exchange that actually has an effect on the stock, are actually sell orders. And so this is why we see AMC share price go down despite of its bullish projections, because the buy orders are being routed in the dark pool and the sell orders are being routed into the lit exchange. And so it's why we've always said there is no real price discovery, why it's an unfair market, because they understand just how much, AMC investors have done and how much we can do when you let all buy orders hit the lit exchange. And that's why they're always trying to avoid this. And then you can also see with the shares available to borrow, you can firstly, we talked about this, how shares available to borrow gives us an indication of what's happening. When you see the large increase in shares available to borrow, what we're realizing is that firstly, shorts are rehypothecating more shares because they need more shares to bring AMC down. And then when you're seeing those shares being used, you understand that they are desperate. So not only are they creating these shares to fill the market, but they're also using these shares to then short AMC. And that's how we're seeing, shares available going from 7.1 million all the way down to 4.7 million. This is done by them borrowing these shares. And then when we realize that the 4.7 million to go up, in numbers again, whether it's back to 7 or it's go to 8 million, you have to realize that most of the time, and I'm not saying all of the time, but most of the time it isn't because the shares are returned back into the pool, but rather on top of the shares they've just borrowed, they need more shares. Hence, they created even more synthetic shares. And that's why, you see it ranging from 7 million down to 4 million and then back up to 7 million. It isn't because the 3 million shares are returned, but rather they created an extra 3 million synthetics. And the reason we know this, and the reason why this is extremely bad for the short sellers, is because what it has done in the past. You have to realize is that the toxic swaps from Archegos collapsed Credit Suisse, and now what we're seeing is that the very same toxic swaps are obviously being inherited by UBS. Now, what do these toxic swaps consist of? Well, a variety of shares, but mainly we know is that it's AMC and GME swaps, because we've seen it in the past with how Archegos took the bets with GME and then Credit Suisse took the bets with AMC. And you saw how both those companies went. Bear in mind is that one company is obviously way bigger. Credit Suisse was way bigger than Archegos, and when it took on to these GME swaps along with it to AMC swaps, we also saw it crash down. And then it's being inherited by UBS, and since then we've only ever seen bad news coming from UBS, whether it's the fact that risk exposure is too big, whether it's the fact that they have no margin and are required to put up more margin. You can all see how since inheriting these toxic swaps, they faced so much liquidity problems. And so UBS could very likely to be the next short seller to go down, but not because they, on purpose took the short position, but because they had to inherit it. But another company, another firm that actually has purposely shorted AMC is Citibank. We can see Citigroup, the parent company of Citibank, reported a net balance of 109.49 billion in securities sold not yet purchased, aka short positions. And so this is an increase of $10.31 billion in quarter over quarter. And the reason why I'm highlighting this is because we have seen how Citigroup has tried to obviously screw AMC in the past. We know that they are a short seller of AMC. More importantly, we know that they have synthetics of AMC. One of the early data that has shown the synthetics that exposed these institutions was the fact that Citigroup had AMC shares offshore in the Brazilian ADR shares, which was shown in the past. And during then, they had almost 100% of the float of AMC. And so we knew that they created almost an entire float for themselves. and classed it as obviously these Brazilian ADR shares. So this is another firm that's holding on to extremely toxic positions. And so that's what we talk about when we understand how firms are all on the verge, and why we know that there are going to be firms that are going to be coming down very, very soon. But yeah, guys, that's it for this video. I hope you guys enjoyed. As always, none of this is financial advice, so do take a second and salt. Make sure to do your own due diligence and research, and I'll catch you guys next time.